All right, let's talk about crypto trading. It's this wild, chaotic world, right? But believe it or not, there can be a method to the madness. Today, we're going to pull back the curtain and see exactly how the pros try to make sense of it all.
So you've probably been there. You pull up a crypto chart and what is that? It's just this crazy, jagged line bouncing all over the place. For most of us, trying to guess what happens next feels like, I don't know, flipping a coin, a total shot in the dark.
But here's the thing. For the pros, that chaotic chart, that's just level one. It's the very surface of a much, much deeper game. They're peeling back all these different layers of data, looking for clues the rest of us completely miss. And that's what we're going to do right now. Let's start peeling. Okay, so level one, reading the chart's momentum. This first layer is what a lot of people call technical analysis. It's all about looking for patterns and clues hidden right there in the price action itself. It's kind of like being a detective, but for charts. So one of the most classic tools in the box for this is something called the Relative Strength Index, or RSI. The easiest way to think about it, it's like a speedometer for the market's momentum. It spits out a number between 0 and 100. If that number gets really high, it's a sign the market might be overbought, running out of gas. If it gets super low, it might be oversold and maybe due for a bounce. But here's where it gets really cool. The magic happens when the price and the RSI start telling two different stories. This is what traders call a divergence. So look at the left side here. That's a bullish divergence. The price is making a new low, but look at the RSI. It's actually making a higher low. It's like a secret little whisper that the downward push is losing its power. And on the right, it's the complete opposite. Price hits a new high, but the RSI can't keep up. That's a big flag that the rally might be getting tired. And this really gets to the heart of it. The team at Kraken puts it perfectly. A divergence is basically a warning sign. It's telling you that the trend you're seeing, well, it might be an illusion. The momentum just isn't there to back it up, and change could be right around the corner. All right, that was layer one. Now let's peel back another one. Level two, reading the blockchain's health. See, we're going beyond the chart now and looking at the blockchain itself. Since crypto runs on these public ledgers, there is a literal treasure trove of data just sitting there telling us about the network's health and what investors are doing. This whole field is called on-chain analysis. Okay, so check this out. On the left, you have something called net unrealized profit/loss, or NUPL for short. It's basically a vibe check for the entire network. Are people, on average, in profit or in loss? When it's way up, that's euphoria. When it's way down, that's pure panic. And on the right, you've got the percent of addresses in profit. Super simple, what percentage of wallets are in the green? Together, these things give you a really powerful snapshot of the overall market sentiment. And hey, this isn't just some fringe idea. A 2022 study dug into on-chain data just like this and came to a really interesting conclusion. Crypto markets are informationally inefficient. Now, what the heck does that mean? It's just a fancy way of saying that the price doesn't always reflect all the known information right away. And that's huge. It means this on-chain data can actually give you a real edge. Okay, so we've got chart data, we've got on-chain data, there are real clues here. But the next big problem is how do you act on this stuff fast enough and, without your emotions getting in the way? Well, that brings us to our deepest layer yet, level 3, inside the trading bot. Now, algorithmic trading sounds super complicated, right? Like some sci-fi stuff. But really, these bots aren't magical black boxes. They're just sets of simple, predefined rules that run automatically. Let's actually look inside one. This is the logic for what's called a capitulation long bot. It's not trying to predict the future. It's just following a recipe, a checklist. Step 1, has there been a super sharp panicky dump in price? Check. Step 2, is the RSI screaming oversold, like below 28? Check. Step 3, did that dump happen with a massive spike in trading volume? Check. If all 3 boxes are ticked, then and only then does it execute step 4, a quick little trade betting on a short-term bounce. See? It's just a simple if this then that process. And of course, there are tons of these bots, each with its own little recipe. You've got bots looking for things that have gone up way too fast and are probably going to crash. You've got others trying to pinpoint the exact moment a trend is about to die. But the key takeaway here isn't the specific strategy. It's that bots aren't about being smarter than everyone else. They're about discipline. They take human emotion, fear, greed, all of it, completely out of the equation and just play the odds over and over and over again. Okay, so let's zoom out. We've got chart reading, we've got deep blockchain data, we've got automated bots. Traders have this whole arsenal of tools at their disposal. Which brings us to the big picture and really the most important question of all. Does any of this stuff actually work? Does it guarantee you'll make money?
And this is where things get really interesting. Just look at these two headlines. They came out around the same time. The one on the left, totally bearish. It's pointing to all these red flags in the data. The one on the right, super bullish. It's seeing signs that the bottom is in. And the craziest part is, both analysts are probably using the same kinds of data we just talked about to make their case.
So what does that tell you? With all these fancy tools, all this data, how on earth can two smart people look at the same market and come to completely opposite conclusions? Who's right? And the answer, the real secret to all of this, is maybe neither of them is right. Because the goal of all this analysis, all these tools, it isn't about finding a crystal ball that tells you the future. It's not about being right 100% of the time. The real goal is to find an edge, a small statistical advantage that over hundreds or even thousands of trades just tilts the odds a tiny bit in your favor.
And that really leaves us with the ultimate question, doesn't it? In a market this complex, a game where everybody is desperately searching for an advantage, where will traders find the next edge? That's the real story here. Thanks for tuning in.